Hi friends, welcome to my YouTube channel Learn Commerce with Namita. I am Namita Mane. In today's session, let us discuss the functions of a bank. In my last lecture, I have explained you the structure of Indian banking system. In today's session, let us see the functions of a bank. So let's start. So the functions of a commercial bank is in the flow chart. The functions of a commercial banks are classified into two functions. First is primary functions and second is secondary functions. Under primary function, banks accepts deposits, they grant loans and advances. These are the primary functions of a commercial bank. And under secondary function, banks perform the functions of agency functions, then general utility function, and distribution of third party product. In today's video, I am going to discuss about only primary function, and in next video we are going to see the secondary functions. So let's see the functions, the primary functions of a commercial bank in details. This is the primary functions of commercial bank. First is accepting deposit. Primary functions of a commercial bank is classified into two types. First is accepting deposit. Second is granting loans and advances. Then further, the accepting deposits are classified into two types of deposits. That is demand deposits and time deposits. Under demand deposits, there is saving deposits, current deposits, and under time deposits there is fixed deposits and recurring deposits. These are the deposits under accepting deposits, and accepting deposits is the primary function of commercial bank. Next is granting loans and advances. Under granting loans and advances, bank provides loans, overdraft facility, cash credit, then purchasing and discounting of bills. We are going to see this in detail. First we'll see accepting deposits. The relationship between a banker means a banker and his customer. The relationship between a bank and his customer begins with the opening of an account. Okay, when the relationship between the banker and a customer begins when the customer open an account in a bank. So that time, from that time, the relation between the customer and a bank is a banker and a customer. So initially, when a customer opens an account with a bank, he or she deposits some amount of money in bank. So deposits are the amount of money that a customer hands over to the bank. Means when the customer opens an account, that time whatever amount of money he is handing over to the bank, that is nothing but a deposits. Okay. Next, commercial banks accepts all types of deposits. Commercial banks, the primary function of a commercial bank is accepting deposits, and it accepts all types of deposits from individuals and organization, from individual customer and from business like small scale, big scale, then from educations like schools, colleges, even they have an account with the bank. And the motive of accepting the deposits from the customer is that they mobilize the public funds. Then they provide a safe custody of saving, and they gives interest on the saving to the depositors. Okay, so the motive or the objective behind accepting the deposits from the customer is that they make the habit of saving to the customer. They provide some safe custody of that saving amount, And second thing, when a customer deposits the money or he saves the money in the bank gives interest on that saving. Now, bank accepts two types of deposits, that is demand deposits and time deposits. Now, what is demand deposits and time deposits? We'll see in the next slide. Now, demand deposits. First, we'll see demand deposits. Demand deposits. Now, what are demand deposits? Demand deposits are the deposits which are withdrawal on demand. Means whenever the customer is in need of money, and if he is having an account with the bank, then whenever he needs the money, he can visit the bank and withdraw the money as per his need. Okay, so demand deposits are the deposits which are withdrawal on demand. Now, demand deposits includes two types of deposits. It includes saving deposits and current deposits. Now, first, what is saving deposits? Now, saving deposits is what? It is like it encourages the saving habits amongst the public. Okay, saving deposits means whenever you open an account, saving account, so what basically you are doing and what bank is doing? Bank is encouraging the public to save the money. Okay, so it encourages saving habits amongst the public, and this saving deposit account is suitable for salary and wage earners. Okay, who is getting every month salary and wages. Salary is when you get after you work for 1 month, and wages is the amount, the money which you get per day. Okay, so it is suitable for the people, for the salary earners and the wages earner. The rate of interest on saving deposit is low. Normally, bank gives interest of 4%. The account for saving deposit can be opened in single name or in joint name. Now, if you want to open a saving deposit account in a bank, you can open it by a individual name or by joint name also. Okay, joint name means more than one person, that is what joint account, and single person means a single account holder, and joint account means you and plus one more partner, that is called as joint account. So joint account also can be opened in saving deposits. The depositors just need to maintain minimum balance. Okay, now depositors are required whenever they open a saving account, they have to maintain some minimum balance in their account. Now this minimum balance varies across different banks. Now each bank has kept the different criteria for saving account. For example, if you have an account in Bank of Maharashtra, so in Bank of Maharashtra, if you have a saving account, so you are required to maintain minimum balance like 2000 rupees compulsory in your saving account. And also along with the when you open the bank account, bank provides the ATM cum debit card on saving account, then checkbook and internet bank facility. Okay, so you get this services from bank when you open a saving account. Now withdrawal means when withdrawals are also allowed. You can withdraw money from your saving account, but in a limited numbers. Now there are withdrawal per day, there are some restrictions to withdraw money from your saving account. Okay, so this is all about saving deposits. Next is current deposits, means current account. Now current account are opened by businessmen and other commercial organizations such as hospital, educational institutions, etc. Now current account are opened by businessmen or any other commercial organizations like educational institutions, hospitals, or by any small scale industry. Now the current account holder gets the overdraft facility on this account, means the holder of the current account gets the overdraft facility. Okay, overdraft facility is a type of a loan which bank gives to the current account holders. This deposits means current deposit act as a short term loan, okay, to meet the urgent needs. Now in current account, withdrawal means you can withdraw money freely, okay, you can, there is no restrictions for withdrawing the money from current account. Now there is no interest paid in current account. In saving account, interest is paid by bank, okay, but that interest is very low. In current account, bank does not pay any interest, and in fact they charge the services, okay, they bank charge services, they charge the service which you when the bank gives to the current account holder. So bank charge some amount, service charges are charged to the account holders, current account holder. So the current account is opened by in short, current account is opened by businessman, okay, and to the current account holders, bank gives overdraft facility. Overdraft facility is nothing but a short term loan. And to second thing is what, you can withdraw as many amount from current account, and there is no limit for withdrawing the money. Current account holders do not get any interest from the bank. In fact, there are some service charges paid by the customer to the bank. Next is time deposits. Okay, now what are time deposits? Time deposits are the deposits which are repayable after certain period of time. Now time deposits means the deposits which you keep with the bank are those deposits you can get back after certain period of time. Means for that time period the money is fixed with the bank. So time deposits includes fixed deposits and recurring deposits. Now what is fixed deposit? Fixed deposits are also known as term deposits. Now fixed deposits is also known as term deposits. A lump sum amount is deposited at a one time for a specific period. Now for example, if you are depositing 10 lakh rupees, okay, 10 lakh rupees you want to deposit in a bank as fixed deposit. So this 10 lakh rupees is fixed for and you want to deposit this 10 lakh rupees for 20 years. So this 20-year is a fixed time period, okay, that's why fixed deposit comes under time deposit. So this 10 lakh rupees you are depositing in a bank for 20 years. So after 20 years only you can withdraw the money from the bank. After 20 years only you can remove 10 lakh rupees from the bank, okay. So it is a fixed amount which you are depositing in a bank, and for a specific time period. So the lump sum amount is deposited at one time for a specific time period. And when you are depositing the money for 10 years, 20 years, you get a higher rate of interest, okay, higher rate of interest is paid, okay. Now this rate of interest depends upon the number of period or number of time you are keeping it. Now for example, if you keep the deposit for 5 years, so rate of interest will depend on the number of months, okay, number of years, that is for 5 years. If you are keeping for 10 years, then the rate of interest will increase, and this rate of interest is paid by the bank to the customer. Withdrawal means the repayment of these deposits are not allowed, okay, not allowed before the expiry of the period. Means suppose if you are keeping 10 lakh rupees for 20 years, so before 20 years, okay, you cannot withdraw 10 lakh rupees from the bank. In certain case, okay, in certain case, if the customer wants, if the account holder wants to withdraw money before 20 months, before the maturity, the bank will charge some penalty, that is called some penalty. Means the interest rate will be reduced and then the customer can withdraw the money. Okay, so withdrawal are not allowed before the expiry of the period, but in case depositors withdraw before maturity, bank charge a penalty for premature withdrawal. Okay, you can remove the money, you can withdraw that fixed deposit amount before the maturity, but bank will charge some penalty. They will charge some low interest rate on the fixed deposit. Next is recurring deposit. Now recurring deposit is what? A certain sum of money is deposited in the bank at regular interval. Okay. Now fixed deposit is what? For fixed amount you are investing with the bank, means you are depositing with the bank for fixed time period. Okay, for 5 years, 10 years and so on. And recurring deposit is what? A certain sum of money. For example, 2000 rupees you are depositing in a bank at regular interval. Regular interval means every month you are depositing. You have opened a recurring account, and every month recurring amount is 2000 rupees, and 2000 rupees every month you are paying to the bank. Okay, you are depositing in a bank. That is what a regular saving habit which you are doing. For regular, for example, 2000 rupees, with 2000 rupees you have opened recurring deposit account, and this 2000 rupees you are going to pay for 2 years. Okay, so for 24 months, in 2 years how many months are there? 24 months. So every month you are paying 2000 rupees. Okay, that is what a regular interval, that is nothing but a recurring deposit. So for 24 months you are paying 2000 rupees, and the money can be withdrawn only after expiry of a certain period of time. Means this 2000 rupees which you are depositing every month in a bank account for 24 months. So after 24 months a lump sum amount you are going to get. So 2000, if you multiply by 24, so almost you will get at least around 24,000 or 25,000 you will get after 2 years. Okay, after 2 years you will get the along with your interest, you will get the amount after 2 years. So you cannot withdraw this 2000 rupees or the lump sum amount in between. Okay, you cannot in between 2 years you cannot withdraw the money. After the expiry, means after the maturity of that deposit, you can withdraw it, and a higher rate of interest is paid on recurring deposits. Okay. Next is granting loans and advances. So this is the under primary function there is accepting deposits. Under accepting deposits there is demand deposits and time deposits. And the second part of a primary function of a commercial bank is granting loans and advances. Now the deposits accepted from the public. Okay, the bank accept deposits from public, and this deposit bank utilize them in the form of loans. Okay, they accept the deposits from the customer, and this deposit which they have accepted from the customer, they utilize, means they lend this money to the customer in the form of loans and advances to the businesses or to any individual person to meet their uncertainties. To meet the uncertainties means whenever a businessman or individual person requires loan, the bank grant loans and advances to that particular person. Now bank charge a higher rate of interest on loans and advances. Okay, then what it pays to and what it pays on deposit. Now when bank accepts the deposit, bank pay lower rate of interest to the customer on that particular deposit. But whereas when bank is lending the money when bank is giving loans to the customer, that at that time bank charge higher rate of interest. Okay, then only bank earns profit. So bank offers the following types of loans and advances to its customer. It provides loans, then bank overdraft, cash credit, and discounting the bill of exchange. We'll see this one by one in detail. First is loans. Okay, so bank lends money to the customer. Now loans are of three types: short term loans, medium term, and long term loans. Short term loan means between 0 to 1 year, and medium term loans means between 1 to 5 year, and long term means above 5 years. Okay, above 5 years, that is long term loans. So bank lends money to the customer for short term purposes or medium term for the period say 1 to 5 years against tangible assets. Tangible asset means the assets which you can touch, feel, that is tangible assets. For example, furniture, buildings. Okay, these are tangible assets. So against these assets, a bank grant loans to the customer, means it gives loans to the customer. So the borrower repay the loans either in a lump sum amount. Either in a lump sum amount means together. For example, the borrower has the customer has taken loan of 1 lakh rupees. Okay, for 1 year, and after 1 year he can pay a total 1 lakh rupees along with the interest to the bank. If it is not possible for him to pay the amount together, he can pay or he can repay it in the form of installments. Okay, in the form of installments, in the form of EMIs, means every month he can repay that loan amount to the bank. Second is bank overdraft. Okay, bank overdraft. Now this bank overdraft facility is given to only for current account holder. So bank overdraft facility is for current account holder. Now who opens the current account? The businessman opens the current account. So this bank overdraft facility is only given to the current account holder. Now it allows the holder, who is the holder means the current account holder, to withdraw money anytime more than the available bank balance. Okay, but to the provided limit. Okay, now what is this overdraft? For example, you have a current account, okay, in a bank, and in that current account you have 5 lakh rupees. You have 5 lakh rupees. Okay, and at emergency case, in emergency case you require 50,000 rupees. Okay, you require 50,000 rupees. Okay, so you can apply for overdraft facility. Okay, means more than your amount, more than your initial amount, you are taking more 50,000 rupees from the bank. That is overdraft. Overdraft is from more than 5 lakhs. Over than the 5 lakh rupees, you are taking the facility of 50,000 more from the bank. That is overdraft facility, and this overdraft facility is only given to the current account holders. Okay, only to the current account, the customers, they can get this facility. So more in you have you have 5 lakh rupees, but in emergency case you require 5 lakhs and more 50,000. Okay, so more 50,000 if you are requiring, you can take the facility of overdraft from the bank, and this overdraft facility is granted against collateral securities. Okay, bank gives you overdraft facility to the current account holder, but it gives against the collateral securities. Now what is this collateral security? Collateral securities is a asset, okay, or piece of property that a borrower offers to a bank as a security for loan. For example, collateral securities like land, buildings. Okay, and in case the customer fails to repay the loan to the bank, so in that case the bank has the authority to sell that land or sell that building, whatever the customer has kept as a security with the bank. So if customer fails to repay the loan, so bank has the right to sell that land and building to recover the loan amount from the customer. So that is collateral securities. Next is cash credit. Okay, cash credit is a short term loan facility to a specific limit fixed in advance. Okay, so cash credit is a type of short loan facility, and this short loan facility is specific in limit and it is fixed in advance only. So bank allows the customer to take a loan. Okay, bank allows the loan to take a loan against a mortgage of certain property, that is tangible assets or guarantees. Bank gives loan, okay, short term loan to the customer, and this loan is given against the certain property or certain assets. Then if the customer fails to repay that loan to the bank, so bank can sell that property and they can recover those dues from the customer. Okay, so cash credit is given to any type of account holder. Okay, overdraft facility is only given to the current account holder, but cash credit is given to all type of account holder, whether it is a saving account holder, current account holder, fixed deposit account holder, or recurring deposit account holder. So they can get this cash credit facility. And also to those who do not have an account with a bank. Okay, if they can give to the cash credit facility, bank can give to the customer who do not have an account with the bank also. So this facility bank can give to the customer. Next is discounting the bill of exchange. Okay, discounting the bill of exchange. Now it is a type of short loan where the seller discounts the bill. Now I hope everyone knows what is bill of exchange. Okay, bill of exchange is what, when the seller and the buyer, okay, when seller sells the goods to the buyer on credit, and at that, when the buyer is purchasing goods from the seller, at that time the buyer is not having money. So in that case, what does the seller does? Seller says that okay, I will give you the goods and you pay me the money after 90 days or after 1 year, whatever. So as a guarantee, the seller draws one bill to the buyer that you have to pay me 10 lakh rupees or 50 lakh rupees after 90 days. Okay, so that is what a bill of exchange, what that the seller gives to the buyer in the case of only credit, when the seller sells the goods to the buyer on credit. At that time, as a safe aside or as a guarantee, the seller draws the bill to the bill on the buyer. Okay, so discounting the bill of exchange, bank can discount the bill of exchange. So it is a short term loan where the seller discounts the bill from the bank, okay, for some fees. Okay, so seller discounts the bill from the bank for some fees. The bank advances money by discounting or by purchasing the bill of exchange. So when the seller is drawing the bill to the buyer, okay, and if and that payment which the buyer is going to give to the seller, it is mostly after 30 days, after 90 days. Okay, but in the time period of 90 days, the seller requires money. So what does the seller will do? He will go to the bank and he will discount that bill, and the bank will pay the money to the seller. Okay, so it pays the bill amount to the seller on behalf of the drawee. Okay, now X is the seller and Y is the buyer. X draws the bill to Y, okay, for 90 days. Okay, for 90 days. X draws the bill to Y for 90 days. Now of rupees, suppose 1 lakh rupees. 1 lakh rupees, seller draws the bill on the buyer for 90 days. 90 days means 3 months of rupees 1 lakh rupees. Now, and this bill he gives to the buyer. But in between this 90 days, seller needs money. Okay, seller needs money. And he knows, seller knows that I am going to get 1 lakh rupees after 90 days. But in between this 90 days, seller needs money. So what does the seller do in this case? He goes to the bank. Okay, he goes to the bank with the bill and takes the amount of this 1 lakh rupees. Okay, from the bank. Okay, and bank will charge the commission, means the bank will charge, for example, 10% on 10,000 on 1 lakh rupees. So bank will reduce that money. For example, 1,000 rupees they will cut from 1 lakh rupees, and the remaining amount they will give to the seller. Okay, so bank will pay the money on behalf of this buyer. Okay, on behalf of this buyer, bank will pay the amount. Okay, see, if it pays the bill amount to the seller on behalf of drawer. Okay, and by deducting usual discount charge, means they will charge some on 1 lakh rupees, bank will charge some interest, and then bank will take the interest and they will reduce from this 1 lakh rupees, and whatever amount is remaining they will give to the seller. Okay, so on the maturity, okay, means after 90 days, bank presents the bill to the drawee. Present the bill to the drawee means bank will take money from this Y after 90 days. Okay, to collect the bill amount. Clear? So this is discounting of bill of exchange. I hope you have understood. Now I will repeat again. I will explain this again. Now X and Y. X is the seller, Y is the buyer. X sells the goods of 1 lakh rupees to Y on credit. Okay, and in return X draw one bill of exchange to Y that you have to pay me 1 lakh rupees after 90 days. In between this 90 days, Y needs money. Okay, Y in between the 90 days, X needs money. X knows that Y is going to pay me money after 90 days. But at urgent case, at emergency case, X needs money. So what does the X do? He goes to the bank with the bill and he takes the money from the bank of 1 lakh rupees. And but now bank will charge some discount on this 1 lakh rupees, and they will take that discount amount. Bank will take the discounted amount and remaining amount they will return to X. And after 90 days means on the maturity, means after 90 days the bill is going to mature. So after 90 days bank will present the bill. Okay, bank will present the bill to Y. Okay, Y is who? Drawee, to collect the bill amount. Okay, bank will collect the bill amount, means will collect 1 lakh rupees from Y. Okay, after 90 days. So this is nothing but discounting of bill of exchange. Okay, discounting or purchasing the bill of exchange from the customer. Okay, so these are the primary functions of commercial bank. Okay, I hope you have understood all the primary functions of commercial bank. In next lecture, we'll see the secondary functions of commercial bank. Thank you. Please subscribe my YouTube channel, like and share the video, and do not forget to press the bell icon to get the latest notification.